the Bombay Stock Exchange or BSE Sensex. It's more than just a stock market index, it's the pulse of the Indian economy, a barometer of its hopes and dreams. For 3 decades, the Sensex has mirrored India's journey, reflecting its growth, resilience, and potential. From a fledgling economy in 1994 to a global powerhouse today, India's transformation has been nothing short of remarkable. And the Sensex has been there every step of the way, chronicling the highs and lows, the booms and busts. Understanding the Sensex is about more than just picking stocks, it's about grasping the forces shaping India's destiny. So, buckle up as we take a trip down memory lane, exploring the 30-year saga of the BSE Sensex, its volatile swings, and the enduring story of growth it tells. In 1994, the Sensex stood at around 4,000 points. Fast forward to 2024 and it's hovering above 78,000. That's an astounding 20-fold increase. But don't let the numbers fool you. The journey wasn't a straight line upwards. It was a roller coaster ride, full of twists, turns, and heart-stopping drops. We saw periods of euphoria, where the market seemed unstoppable, and times of despair, when investors questioned everything. Yet through it all, the Sensex kept climbing, mirroring India's economic expansion. The 1990s were a time of liberalization and reform for India. The country was undergoing a significant transformation, moving away from its socialist past and embracing a more market-oriented economy. The economy opened up, and foreign investors took notice. Multinational companies began to set up shop, bringing in much-needed capital and expertise. The Sensex responded with enthusiasm, but volatility was the name of the game. The stock market saw unprecedented highs and lows, reflecting the uncertainty and excitement of the times. In 1995, the Barings Bank collapse sent shockwaves through global markets, and the Sensex tumbled. This event highlighted the interconnectedness of global financial systems. The Asian financial crisis of 1997 added to the turbulence. Countries across Asia were affected, and India was no exception, feeling the ripple effects in its own markets. Domestic, political instability, including the resignations of Prime Minister Vajpayee in 1996 and 1999, further fueled the volatility. Political uncertainty often translated into market instability. Just as things seemed to be stabilizing, the Kargil War erupted in 1999, sending the markets into a tailspin. The conflict added another layer of complexity to an already volatile decade. The 1990s were a turbulent decade, but they laid the foundation for India's future growth. The reforms and changes set the stage for the economic boom that would follow in the next decade. The Sensex, despite its wild swings, reflected the growing pains of a nation finding its feet on the global stage. It was a decade of learning, adaptation, and laying the groundwork for a more prosperous future. The dawn of the new millennium brought with it the dot-com bubble. Tech stocks soared, and the Sensex rode the wave of optimism. But the bubble burst in 2001, bringing the markets crashing down to earth. The 9/11 attacks later that year sent shockwaves across the globe, further dampening investor sentiment. India's own general elections in 2004 injected more uncertainty into the markets. However, the Indian economy was gaining momentum, and the Sensex reflected this underlying strength. That is, until the global financial crisis hit in 2008. The Lehman Brothers bankruptcy triggered a global meltdown, and the Sensex plummeted. It was a stark reminder of the interconnectedness of global markets and the speed at which sentiment can shift. Section 5. The tumultuous 2010s, From Crisis to Reform. The aftershocks of the global financial crisis continued to be felt in the early 2010s. The world was still reeling from the economic turmoil that had begun in 2008, and the recovery was slow and painful. Many economies struggled to regain their footing, and the financial markets were marked by uncertainty and volatility. The Eurozone debt crisis in 2011 added to the uncertainty. Countries like Greece, Spain, and Italy faced severe financial distress, leading to bailouts and austerity measures. This crisis not only affected Europe but also had ripple effects across the global economy, shaking investor confidence worldwide. However, India's resilience shone through. Despite the global economic challenges, India managed to maintain a relatively stable growth trajectory. The country's large domestic market and robust consumption patterns played a crucial role in cushioning the impact of external shocks. Domestic demand remained strong, and the government implemented key reforms. These reforms aimed at improving the business environment, attracting foreign investment, and boosting economic growth. Initiatives like the Make in India campaign and the Digital India program were launched to modernize the economy and create jobs. The Sensex, while still volatile, continued its upward trajectory. Investors remained cautiously optimistic and the stock market reflected the underlying strength of the Indian economy. Despite occasional dips, the long-term trend was positive, signaling confidence in India's growth story. In 2016, Prime Minister Modi's bold move to demonetize high-value currency notes sent shockwaves through the economy. The sudden announcement aimed at curbing black money and counterfeit currency led to immediate chaos, with long queues at banks and ATMs as people scrambled to exchange old notes. The Sensex reacted sharply, but the long-term impact was debated. While some analysts believed it would lead to a more transparent and formal economy, others pointed out the short-term disruptions to businesses and the informal sector. The true effects of demonetization would take years to fully understand. The rollout of the Goods and Services Tax, or GST, in 2017 was another major reform. This unified tax system replaced a complex web of state and central taxes, aiming to create a single market and improve ease of doing business. The GST was seen as a landmark reform in India's economic history. While initially disruptive, it was seen as a positive step towards simplifying India's complex tax system. Businesses had to adapt to the new tax regime, and there were initial teething problems. However, over time, the GST was expected to bring long-term benefits by streamlining tax compliance and boosting revenue. The 2010s were a decade of both challenges and opportunities. India faced numerous economic hurdles but also made significant strides in reforming its economy. The resilience and adaptability of the Indian market were tested, but the country emerged stronger and more prepared for future growth. The Sensex, while experiencing volatility, ultimately reflected India's ability to navigate these turbulent waters. The decade ended with a sense of cautious optimism, as India continued to build on its strengths and address its weaknesses, setting the stage for the next phase of economic development. Section 6, the 2020s, Navigating Uncharted Waters. The 2020s began with the unprecedented COVID-19 pandemic. Lockdowns brought the global economy to a standstill, and the Sensex plunged. However, the Indian government's swift response and massive stimulus package helped cushion the blow. As the world emerged from the pandemic, new challenges arose. The Russia-Ukraine war in 2022 disrupted supply chains and fueled inflation. The Reserve Bank of India responded with rate hikes to tame inflation, impacting market sentiment. Geopolitical tensions, including the Israel-Gaza conflict in 2023, added to the volatility. Despite these headwinds, the Indian economy showed resilience, with strong corporate earnings and robust domestic demand supporting the markets. The 2020s have been a period of extraordinary circumstances. The Sensex, while experiencing heightened volatility, has demonstrated the underlying strength and adaptability of the Indian economy. Section 7, Decoding the Numbers Performance Trends. Beyond the headlines and dramatic events, what do the numbers tell us about the Sensex's performance? To truly understand the market's trajectory, we need to delve deeper into the financial metrics that drive these movements. The Sensex's earnings per share, or EPS, tells a compelling story. This metric is crucial as it indicates the profitability of the companies listed on the index. From 1,507 rupees in December 2019 to 3,322 rupees in December 2024, the EPS has shown remarkable growth. This translates to a compound annual growth rate of 17.1%, a significant indicator of robust financial health. This signifies strong earnings growth for the companies listed on the Sensex, reflecting their ability to generate higher profits over time. Meanwhile, the Sensex's price-to-earnings ratio, or PE ratio, has decreased from 27.4 times in 2019 to 23.5 times in 2024. This suggests that valuations have become more attractive, potentially offering a good entry point for investors looking to capitalize on future growth. Moreover, the return on equity, or ROE, has improved from 12% to 15.5% during the same period, highlighting better capital utilization by companies. This improvement in ROE indicates that companies are becoming more efficient in generating profits from their equity base. These numbers paint a picture of an economy that, while facing challenges, is fundamentally sound. The underlying strength of the companies is evident in these metrics. The strong earnings growth coupled with attractive valuations bode well for long-term investors. It suggests that the market is poised for sustainable growth, making it an opportune time for strategic investments. Section 8. The Long Game Investment Takeaways. The Sensex's 30-year journey offers invaluable lessons for investors. Firstly, volatility is an inherent part of the market. There will be ups and downs, booms and busts. Don't panic during downturns. Instead, view them as opportunities to buy into quality companies at attractive valuations. Secondly, focus on the long term. Short-term market fluctuations are noise. India's economic growth story is far from over. Invest in companies with strong fundamentals, sound management, and a proven track record. Thirdly, diversify your portfolio. Don't put all your eggs in one basket. Invest across different sectors and asset classes to mitigate risk. Finally, stay informed. Keep abreast of economic trends, government policies, and global events that could impact the markets. Knowledge is your best defense against uncertainty. Section 9. Conclusion: riding the roller coaster to prosperity. The BSE Sensex's 30-year journey has been a roller coaster ride, reflecting the dynamism and resilience of the Indian economy. From liberalization to globalization, from financial crises to technological disruptions, the Sensex has weathered it all, emerging stronger each time. While market volatility is inevitable, the long-term outlook for the Indian economy remains positive. With its young population, growing middle class and entrepreneurial spirit, India is poised for continued growth. The Sensex, as a barometer of this growth story, is likely to continue its upward trajectory, albeit with its share of bumps along the way. For investors, the key is to stay invested, stay focused on the long term, and ride the roller coaster to prosperity.